In the last 3 months, the Indian rupee has depreciated by about 4%, and there is genuine debate of it coming close to 80 rupees to the dollar in the near future. While this might not be enough to dampen your vacation plans to the United States this summer, a drop in the value of the rupee is likely to pinch your pocket in a number of other ways. And so in this video, we examine the rupee depreciation in greater details as we understand its reasons, its implications, which sectors is it likely to affect, and what are the recourses available on a policy and consumer front. Let's begin. The depreciation of a currency basically means a fall in its purchasing power. And this power comes from nothing but the demand for that currency. So when the demand for the rupee increases, its value goes up, and when that demand declines, the value goes down. Now, the demand for the Indian rupee goes up when foreigners make investments or purchases in India. They use their dollars to buy Indian companies, Indian goods, and Indian services. And as they convert their dollars to rupees, the value of our currency goes up. On the other hand, when we import something like crude oil, gold, raw materials, semiconductors, etc., we pay in dollars, which means we sell rupees to buy dollars, which therefore weakens our currency against the US dollar. Now, India has been a net importer for many years. That is, we import more than what we export. And the rupee has gradually depreciated over time against the US dollar. In fact, at the time of our independence, $1 US was available for a little over 4 rupees. This conversion rate crossed the 10 rupee mark in 1983, the 20 rupee mark in 1991, the 40 rupee mark in 1998, and the 70 rupee mark in 2018. This recent 4 to 5% fall over these last 3-4 months is a bit concerning, and our research has put forth 3 factors that seem to be dragging the rupee to historic lows. Firstly, there's the fact that overseas investors are exiting the Indian financial markets. And while the Russia-Ukraine war might be partly responsible, we believe the Federal Reserve's intention and announcement to aggressively increase interest rates is the bigger factor here. So as money moves from India back to the US, these investors are converting their rupee holdings into dollars, which strengthens the dollar and pulls down the rupee. A second reason leading to rupee depreciation, believe it or not, is the delay in LIC's IPO. You see, the general expectation was that the Life Insurance Corporation of India would have an $8 billion IPO in March, and this would result in a $2 billion inflow of foreign currency into the country. Unfortunately, the IPO has been postponed, and speculation is rife that this would be pushed to the middle of April or even the month of May. A third reason accounting for the sharp fall in the rupee's value is the price of oil. Now, India is a net importer of crude oil, and since global oil prices have spiked by over 60% since the start of 2022, Indian companies are having to shell out more dollars, which comes at the expense of a weakening dollar-rupee rate. In fact, India imports almost 80% of its oil needs, and a depreciating rupee, amongst other things, also bloats our current account deficit, which is expected to cross 3% for the first time in decades. And it's not just the current account deficit. In fact, the value of our rupee plays a critical role in providing stability to other major indicators like the fiscal deficit, the balance of payment, the inflation, and a good chunk of the country's GDP. So every time these deficits go into precarious territory, the country does need to dip into its foreign currency reserve to finance the gap, even if there is an absence of dollar inflows. Now, as you might have imagined, this is the job of our central bank, which is the Reserve Bank of India. Of course, the RBI has an option here, and it might choose to intervene in the foreign exchange market to prop up the rupee, or it might allow the rupee to depreciate as long as it is within an acceptable range. Understandably, if RBI chooses the former, it supports the rupee by dipping into its foreign reserve and then selling some dollars in the interbank market. For now, the RBI holds more than $630 billion worth of forex reserves, but the present uncertainty around the war, the rising inflation, and potential speculation around the rupee does limit the central bank's ability and willingness to deploy these reserves. But here's what the RBI did do. In the month of March, they supplied $7 billion to the interbank market through a $2 billion direct sale, which is pretty straightforward, and they also conducted a $5 billion rupee swap auction. A dollar rupee swap is a transaction where the RBI buys US dollars from different banks in exchange for Indian rupees and then immediately gets into an opposite deal promising to sell dollars to these banks at a later date. This way, these forex swaps help central banks like the RBI with liquidity management, which is a good tool to have, but nevertheless, the impact of such an arrangement is only incidental to the currency. But it does help to a large extent, and if everything goes as planned and if the rupee were to slide further, there is a serious case for the RBI to conduct more such auctions in the coming days. The general perception with foreign exchange rates is that it does not affect the common man other than the petrol becoming expensive. But if you look closely, a sharp fall in the rupee can and probably does impact our finances in a number of ways. For instance, and this is a no-brainer, that foreign travel becomes more expensive. So if you're going abroad on business, for medical treatment, studies, or on a vacation, a weaker rupee means one would have to shell more of it for buying dollars, which means your costs will go up. A second outcome of falling exchange rates is the impact it has on inflation, especially on the products we import from other countries. Products like oil that runs our cars and two-wheelers, electronic items that we often tell our friends to carry along when they travel to India, and of course there is gold, of which we Indians are the largest consumers. So as the dollar becomes more expensive, these imported items come at a higher cost, which pinches the pocket of the everyday Indian. Yet another unpleasant consequence of the depreciating rupee and the imported inflation that comes with it is its effect on interest rates. You see, a moderate level of inflation in a healthy economy is more than welcome, as it does not pinch the consumer and encourages business activity. But when inflation suddenly spikes, the RBI is forced to take action by increasing the interest rates, which cools down the economy but has a negative effect on the economic growth. Further, an interest rate hike also means that your home loan EMIs and any fresh loans you might take will cost you a lot more, which can easily upset your finances. And finally, a depreciating rupee can result in your investments taking a tumble. Specific to equities, we are already experiencing a fall with foreign investors pulling out, and even in the case of debt instruments, one is likely to see shrinkage as rising interest rates are inversely correlated to the bond prices. So these are four areas which directly affect us as Indians. But having said this, if you are a non-resident Indian, then you would have seen an increase in the notional rupee value of dollar deposits that you have kept in FCNR accounts in India. In a similar thread, if you have invested in international funds or US-based stocks, then a depreciation in the rupee can be to your advantage, because when you redeem or sell those investments, your holdings will get converted at a higher rupee value than the one you invested in. Of course, I have to mention here that the exact reverse will also happen in cases where the Indian rupee becomes more powerful to the dollar, and therefore currency risk is something that everyone who invests in international funds always needs to carry. Let's start with the sectors that are likely to benefit, and understandably these are the ones that have a substantial amount of foreign exchange earnings. The IT sector is one such beneficiary, and as some reports have quantified, every 1% fall in the rupee's value has a potential to improve a major IT company's profits by 0.5% to 1.1%, which is quite a jump. Likewise, the pharmaceutical sector, which obtains 60 to 80% of its revenue from exports, also stands to benefit from a fall in the rupee, although this does come with some conditions. On a macro perspective, a weakening rupee benefits Indian exporters as they get more value for the same amount of goods that they export. But on the same thread, this advantage would not play out by much for any exporter who also needs to import a bulk of their raw materials. A good example of that is the pharma sector, where at least 70% of the raw materials used are linked to the dollar, which severely limits the sector's upside. As a matter of fact, it is projected that a little over 50% of India's exports involve imported input goods or raw materials, with the bulk of it being petroleum products and precious metals and gems. Likewise, major exports like electronics and organic chemicals are also heavily dependent on imported raw materials. However, Indian companies in the software and textile space, where the dependence on imported raw materials is limited, are likely to benefit from rupee depreciation. On a more social angle, a weak rupee also raises the competitiveness of the domestic industry and allows the country to participate in more manufacturing and service opportunities to serve global consumers. In fact, a falling rupee also makes a case for encouraging domestically produced goods under the Atmanirbhar umbrella, as foreign goods will become more expensive. Okay, with that being said, let's look at the other side of the equation, that is the industries and sectors that are likely to bear the brunt of a depreciating rupee. The most visible one here are those industries that use petroleum products as a major raw material. Oil and its derivatives are used in plastic products, in chemical products, in paints, in detergents, in fertilizers, etc. In fact, specific to fertilizers, the Indian government provides fertilizer subsidies to the tune of 1 lakh crores to our farmers, and it's an industry that is largely dependent on imports to meet its raw material requirements for both urea as well as finished fertilizers. A weakening rupee increases the value of urea imports, which will add to the government's subsidy burden. The automobile and transportation logistics sector is another area where a combination of record high crude prices and domestic inflation can create big disruptions. Yet another area one should be aware of is the extent of borrowings that companies have made in foreign currency. You see, if an establishment has taken loans in dollars and the rupee weakens, then in addition to the interest rate, the borrower needs to use more rupees to pay the lender in dollars. In numbers, corporate India has raised over $6 billion through offshore bond issuances this year, which was raised in a favorable environment of surplus liquidity and low interest rate. But now, with mounting geopolitical concerns, a foreign currency loan can be a big blow to a company's profitability, and this is one factor that investors should account for when picking stocks. So to put it together, a currency's appreciation or depreciation can have a massive impact on a country, a sector, a company, or the finances of an individual. As investors, this can be a catalyst to review and reevaluate one's portfolio for better downside protection, in addition to taking advantage of the opportunities that the currency movement presents. In fact, if you haven't checked out ET Money Genius, then this would be a good time to do that, as our intelligent investing system evaluates prevailing risks and opportunities diligently so that your money can make higher returns, make more consistent returns, and do all that without taking undue risks. And with this, we come to the end of this video. If you like this video, then do tap on that like button, do subscribe to our channel, share this video with your friends, and do join me next week on another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.